we already have a couple things that are on the block that we know we're going to transact with, especially on the retail side, right? We got a couple deals that we're planning on exiting there.
So right now we have 3 properties. We have one listed right now, our IHOP deal in Spring, Texas, which is on the market right now. We've had some interest. We've had about 3 or 4 offers so far. None of them are where we want to strike. And so we're in a hold and wait pattern right now. We have a very long lease on this. It does cash flow very well. Actually, cash flows okay, but this was a buy, hold it for a year and sell. So this was not a long-term hold. And we're just over the year hold for the IHOP right now. And we listed at the end of 2023. So we're just kind of waiting for the right strike price, and then we'll let that one go. And we're also going to list our 2 Applebee's properties in South Carolina, our Applebee's Seneca property, which is a top performing Applebee's in South Carolina. It does great. And then we're also going to be listing our Applebee's Sumter property in South Carolina too.
So 3 on the retail side that we know we will exit. We're always trying to buy things, get the leases extended, have a longer lease. We can sell at a lower cap rate, create some value, and then see if we can exit that opportunity and go find another chance to go do it again. So we're working on that with 3 deals right now, which would be very exciting. On the other side, we've got a couple things where if you kind of take that retail strategy, apply that to commercial, if we can get longer lease terms, or what we call our WALT, if our weighted average lease term is longer, then we'll look, that's really the maximum value point for an asset. So we'll look to exit it at that point. Currently for the commercial side, we've got Palmetto, which is a medical deal, Anderson, South Carolina. We are looking at some lease turnovers right now. And as we get those things signed, especially as we sign medical leases, they're longer term, we'll look to exit that this year. And then we have Midtown. We're going to talk some more about Midtown as well, but that's a deal where we are selling individual stabilized pieces. And then Kingstown on the apartment side.
So Kingstown's a good example that we've talked repeatedly about our apartment assets, because we bought about 45 assets at really our peak, about 4,000 units, and we're down to a little bit over 1,000 units left. And part of the strategy is that we continue to hold the assets that have margin expansion and rental growth. And then as that erodes or we see margin contraction, we'll look to sell it. So Kingstown's a good example that, we really have pushed this thing as far as we think we can take it for the moment. And we want to go out there and see what it's worth, see what the market's worth. We're not seeing margin expansion anymore, and we kind of want to get ahead of the contraction.
Yeah. Our basis there is good. We've owned this deal a while.
Yeah.
I think we're right around 50 a unit is our basis.
It was like 100 deals ago.
I know it was quite a few deals ago now that we bought Kingstown, but that will be one we take out in 2024. There's still, for any real, there's still lots of demand out there. It's like, yes, volume is lower, but there's still demand, especially on the apartment side, for anything that's housing driven to exit. And even, we parsed out some of this stuff at the end of the year from Midtown, and we had great success with those sales. So, all right, that's kind of our wrap right now for where we are seeing that stuff. And next, on tax returns, this is always kind of, we finish the year and how fast are we able to get everything out? We finish our financials around the 10th of the month is kind of our average as to where we fall. Then we are waiting for states to fully open to allow returns and the federal government to open and allow returns. This year, going through it, we did not have a lot of changes on state returns, meaning they didn't change their forms. So we didn't have to wait for updates or new approval timelines. This stuff should open here at the end of January so we can get started on filing these. We then try to send out everything as a package together. So we get all of our K1s at one point, not like, hey, you got some K1s today, maybe you'll get some next week and trickle them out. So we're aiming there to have these done at the end of February. And that's really our target, is to get everything wrapped up, and they'll be posted in your investor account so you can download them all at that point. Okay, we got some other questions here. I assume you're modeling refinance scenarios for affected properties, but if we look at 2025, again, most of our debt, we have 90% of our debt that's out past 2026. So a lot of it is longer term, even out to 2030, fixed rate debt coming due in 2025. We have a few, we should touch base on 2024 first.
Mhm.
We have a few construction loans that are 2024. We're going to finish and roll those to permanent. But we're not, since they're already in a construction phase, they already started with a 7% interest rate. These were not deals where they started at a 2% interest rate or 3%. We don't have anything at 2. Wish we had 2. We don't have any 2. But these all started around 7%. So we're going to refinance those actually probably lower once they're stable than that. Coming in 2025, we've got 6 deals that are coming up, all medical.
You know, well, in Amberwood.
And Amberwood.
But Amberwood's, it's somewhat irrelevant because our debt to value there is, I think,
20%?
yeah, we're like a 4 times coverage ratio. So the impact of interest rates is much less meaningful when you're covering that high.
Yeah, we have, we track these obviously on a quarter by quarter basis. We start working on our renewals about 12 to 18 months out on a loan to see what we can do. So sometimes we get them done. Some of our mobile homes have waited till the last minute to get done. But 2025 is really looking like we'll have medical loans that are renewing. And at that point, we assume interest rates will be a little bit higher than what we got them at. If our average is in the 4s, is what our average debt is. So it'll probably be in the 5s-ish on that kind of stuff. It also very much depends on the length of the lease for what rate we're getting. We could talk about the VA. I mean, that one, the VA, we had a really good interest rate up in Raleigh.
Mm-hmm.
And they signed 1-year renewals. And each year, as they were signing 1-year renewals, interest rates are going up. We couldn't lock in a long-term loan because we had a short-term lease. And therefore, that impacted the loan we could get. And we saw our cash flow definitely pinched because of that. Whereas if we would have just signed a long-term lease with them out of the gates, we could have had a much lower interest rate for a longer period of time.
Yep.
We could have fixed it earlier in the cycle. Instead, we had 2 1-year leases that really hurt us on our renewal for that loan. And most likely not there. They're still going to be
private equity markets to me have always been higher than
they've always been. I mean, if they're
higher than banks,
yes.
Yeah.
But if they're high on the bank side, if we're like a 7-8% on the bank side, the private debt markets are going to be
triple that.
Yeah.
With points on the front end, points on the back end, and
it'd be almost hard money. It's almost a hard money loan. So doesn't.
Yeah, I mean, right now
we did that. We did the whole analysis for starting to buy deals with private money.
Yeah,
and then if you're going to loan money at 7% and you can get a bank CD at 5%, why am I going to give anybody money to earn 2 more points?
They're going to be in the mid-teens easily right now. So
yeah,
I guess the backside of that is if there is no lending option, we don't necessarily, there's not necessarily an immediate fallback plan of, hey, what's going to happen if lending stops within the market. Now, we're not assuming that would happen. We are assuming that if we have a good lease with payment history, that there'll be a lender out there for it, or at least the current lender that's there. Because if there's not a new lender, that means that current lender is going to be on the hook for it too with us. So we don't necessarily see that happening. Even as things got very tight at the end of 2023, loans that were out there were still renewed and worked through with the lenders that were on the books. You want to talk about that part, or is it?
Yeah, it seems like most of the lenders are willing and wanting to just roll things over. So, just have really a reasonable interest rate, and they're willing to work with us.
Yeah. Every time we come up on a capital event timeline, we're looking at everything from extend the loan with the current lender. Can we refinance it, or should we sell it? And we kind of just have to go with what the math tells us to do there. So,
I mean, right now the transaction market is still so tight, especially in the office world. There's almost no office deals being transacted, mostly because lenders are not interested in lending to this asset class right now. So specifically talking about Johnson Square, it's not a very sellable asset at the moment. So we're looking at basically just operating it. We're 91% occupied. It's cash flowing. It's stable. We're paying down debt every month.
Yeah.
We have 3.5% fixed debt until 2026. Just, our plans are just really let it ride until we get closer to that.
Yeah. And then once we get into 2026, we'll look at where are we on the deal. When we purchased that one, we put a lot of money really over the first 24 to 30 months into improvements and extending leases and getting tenants in there and gaining occupancy. We went from 68% to 91%. And now we're just going to hold steady, hopefully there, and operate with the tenants we have. Come 2026, and we're obviously going to be looking at in the middle of 2025 for a 2026 loan to see what we can do. And we'll go through the spreadsheet and the analysis and determine really what generates the best returns. And then decide at that point. And we'll share that with everyone else who do that as well. So our reserve plan on our deals is that we reserve 3 months of operating reserves and then taxes and insurance. So if our operating costs go up for a 3-month period, that means our reserve goal is going to go up as well. So it's kind of a little bit of a double whammy situation there on our net distributable cash flow. And the other part is taxes and insurance. Those are reset in the fourth quarter. And once those are reset, then we're increasing or sometimes decreasing. Hopefully, we're not decreasing too much on the tax.
No, but your point on the double whammy is, we not only did, let's just say operating expenses went up by 20% on the year. So let's say wages and repairs, et cetera, went up by 20%. We're not only getting hit from a cash flow standpoint of that reduction or the increase in operating expenses, reduction of cash flow. We're also getting hit that our reserve strategy is now going up by 20%. And so that also hits cash flow as well. Obviously the property produced that cash and we're benefiting from that, but we're just keeping it on the balance sheet in case of a hiccup.
Yeah.
Yeah.
Retail doesn't really have that on the reserves. Theirs are set and it's not fluctuating. So it's not moving around with the OpEx costs that are there.
For our double net deals, we do a little bit of reserves, but it's just mainly just usually to fix the roof or stripe the parking lot. So
typically we know exactly what that's going to be for.
We know how long a roof lasts and we know how long.
Yeah. So, okay. That's a reserve strategy right there. Those are essentially going to be fairly set for all of 2024. We know what they look like going into it. Our biggest reset would really be at the end of 2024 if we get new tax or insurance numbers for that. And I think we've talked about that enough on our tax and insurance increases that we've seen. But okay, next one, we're going to go into apartment questions. And we really have 3 deals that we want to touch base on and go through and kind of give just some examples of what we're seeing happening in our operations and what we're doing about it. So we're going to run through some numbers quick on these. So the first one we're talking about is Saddle Creek. This is deal 23. This is almost 100 deals ago at this point. We bought this one back in 2016, and we sent some other updates specifically on Saddle Creek as well. But in this deal, our income was up 9% for 2023. But then we look at OpEx and non-OpEx, and overall, those were up 75,000. We made an additional 115,000, up 9.4% in income, but our expenses were up around 10, 11%. So while our margins grew there, so did our costs that were spent on HVAC and CapEx and maintenance. So overall, we had margin compression on this asset. And what that means is when essentially our revenues do not outpace the expenses that we're seeing in operating the deal. And that's where, Josh, you're talking like if we see margin compression, we don't think we can get around it, that's when we're going to look to exit something. Right. So
yeah, I mean, specifically on Saddle Creek, the opportunity we have on this deal is that the plan was to hold until the expiration of these tax credits, and they expired this year. I think
so we're allowed to go free rolling on market rents in January of 26. So we have 2 years.
Okay.
But that means in 2025, we don't really want to have leases that are pushing as long as possible.
Right. Yeah. So, and that's when we'll basically have the most value to that deal, and we can make and show some test cases of where the market is on the deal, and then ultimately decide if we want to continue to hold the deal or sell it at that point.
Yeah. And although we've had a little bit of margin compression, the rental rates there are set by the housing authority. And we feel like waiting another year till we get that really the better value bump is the best decision on this deal here. I would say no. I just think you have to keep in mind that the sheriff departments and the staff and employees that are working for the local agencies and the sheriff departments, like they haven't,
They're behind.
yeah, they're behind. They haven't really been given any additional resources to go execute this. I would say they are very much fighting headwinds and challenges in their own divisions to get this stuff to move faster. So no, things are still operating exceptionally slowly. Georgia, you know, if we look at Georgia just 4 years ago, we had pretty good eviction policy. Like things happen pretty smoothly. That's not the case. It's still taking quite a long time. Commercials probably even slower. You know, 9 months on some of that stuff.
Especially they file bankruptcy.
Yeah.
Pre-COVID, it was basically 60 to 90 days for residential, at least, but that 60 to 90 days is now a thing of the past.
6 to 9 months.
Yeah.
Yeah. You know, during COVID, we were tracking like which tenants owe like $10, $20, $30,000 because they stopped paying entirely. That was like their game plan strategy. We have fewer of those now.
Yeah.
But we still have people that are really working it and coming up with different scenarios for non-paying. But so Saddle Creek, although yes, we had a little bit of margin compression, we still like that deal and want to hold it. East Side, let's talk about that. We had questions on that one. This is a deal. It's on Memorial Drive in Atlanta, and the status is like, hey, what are we going to do here? That's one of our deals. It's a CapEx deal, so it's 10% preferred returns.
Mm-hmm.
And I don't necessarily think we ever get to 10% distributions on a quarterly basis. Right. That's we're close. We generated 8.7% cash here for an annual basis. So we had good distributions, but it's still below that 10% pref rate. I don't think we're going to get to a 10% pref payout, right? That's kind of like the profit calculation, the difference between the 10% pref versus how much can we generate on a quarterly or annual basis. So we have debt locked at 4.5% here till 2029, and revenues we're up over the past 3 years. Revenues are up 25%, and net income's up 57%.
Yeah, it's hard to not bet on that. You know, we continue to see rental growth. We continue to see expansion here. You know, we keep doubling down to this property. It's a great property.
Yeah. Yeah. So we plan to hold this one. Our margins have actually gotten better here. So yeah, this one's been great for us. It's one of the, yeah. Let's go one other one. Another one. Let's talk about Kingstown, because that's one where Kingstown is right near this deal.
Mm-hmm.
So this is deal number 35. So we bought it a little bit later. East Side Crossing was 35. And then we bought Kingstown. Right then at the same time.
Yeah.
But here we're seeing a different story. We're seeing our operating costs go up significantly from last year. Our taxes alone, this is 33 units. Our taxes went up $50,000 last year. So taxes went from 45 to 95. Or no, taxes went from 45 to 95, but then we won our appeal and they reduced them to 90. So they're at 90.
That's a good win, Dave.
Yeah.
Maybe
So
not,
it's like better than
yeah,
better than nothing, but yeah, we went then and tried to say, you know, on our operating business decision that we would have to go increase our rental rates here. We were not able to get those. So we're not able to earn the increase in taxes that we received. So this is the one that we're looking to sell specifically because of that reason. We have margin compression that we're not going to be able to beat it. Right. Someone's going to have to come in and fully renovate the property and remove the affordability aspect of it.
Yeah.
Entirely.
How many units have we done? We've kind of
we did like 6 or 7.
Right. So we've proven a test case as an example from not only from a cost standpoint, but kind of what they could physically look like. And we've gotten rents on a couple of them. Just we're not seeing it going forward, and we don't want to continue to bet that 20 to 30,000 a unit to get those big jumps right now in this market.
Yeah, and arguably, you know, you would need to take rents from the $1,100 to $1,200 range to the $2,200 range, $2,500 range to really make a bigger investment like that worth it. Obviously, that's not very affordable anymore.
Yeah.
Once you're at over 2,000 for a 2 to 3 bedroom townhome. So I think the affordability in the market, you know, taxes go up that much, the affordability in the market goes away. Rental rates have to go up to accommodate that.
Mm-hmm.
So we're gonna look at exiting Kingstown, and any other deal that we see we have problems that where we cannot maintain affordability. We're gonna look to exit that stuff. Right. Okay, that's 3 of our apartment deals. I think that's the general trend we're seeing there, though. If we can keep our margins, we'll go. If our margins get hit and we can't see a way to get out of it, we're going to look to exit those then.
Zaxby's Kennesaw property is doing phenomenal. We actually planned on 84K per year for cash flow, but we're actually doing 121, and we paid down 30K of debt last year, and we're paying returns right now of 9.2%. And this one is I would almost say this is one of our better retail properties. Number one, because we have a debt component too. We made an operator loan on it, and so we're getting interest on the operator loan, and we're collecting rent. And it's a great property. It's a great investment all around. It's probably one of our better ones. So I'm pretty happy with the Zaxby's Kennesaw. How it's performing.
Yeah, I think it performed really well too.
Yeah, and this is a great stable cash flow deal. The 3 Zaxby's that we do with our partner, 2 of them are doing phenomenal. Zaxby's Kennesaw is doing good, but the other ones are getting north of $3 million a year of revenue.
And their store sales.
Store sales, yeah, and that's pretty phenomenal for a Zaxby's. Just
we're always looking at store sale revenue at different chains and different retail opportunities to see how does that store revenue match up to other locations within the same brand. But then also, how do they compare to other stores, right? Yeah. Other same brand stores. So
and
how does
my invitation is always there. If you want me to take you to lunch at Zaxby's, let me know, and I'll be happy to meet you on one of our Zaxby's, and I'll buy you lunch.
Yeah,
Dave likes to go there too. Josh, you'll eat a grilled chicken salad, right?
I have the salad.
Grilled chicken though, right?
Yeah.
Not the fried. Okay,
exactly.
Josh will even go too.
But we're looking at those stores sale numbers, and 3 million is strong, and it works for us. So this is a deal we plan to just keep holding it and operating there. It's good. So now we don't have any immediate updates on that one right now. That's a building where we have a GSA lease that essentially encompassed 3 different suites between 3 different types of tenants. One of those tenants was the FBI. That's a big reason of why we bought that building, is because we were working with GSA. So you're not necessarily like a relationship with the FBI. It's a relationship with the GSA asset manager. And then as they are scheduled to move out at the end of the first quarter here. And at that point, and we've been talking with the GSA asset manager to see, are they going to put a different agency in there? There's talk on them expanding with one of the current agencies that they also represent there. We also have the Secret Service there. And
OSHA maybe
that's a different lease structure
okay.
though. So we're working on that with the GSA tenant, but we don't have any exact update on who that would be right now. So, and I don't want to get the square footage wrong. I think it's roughly 11,000 square feet.
Yep.
That this vacant space will be.
Yeah. So 3 vacant suites in the building. One's about 4,000, one's about 3,000, and this one's about 11,000.
Yeah.
So
after they leave in the end of the first quarter. Yeah.
So I mean, there's a lot of moving parts here it's easier to explain verbally than it is to kind of read or look at a balance sheet. But we went into this loan with this, just like most of our loans, was with this big capital improvement plan. And when we went to basically start the improvement plan, our lender came back and said, no, we're not letting you draw the funds until you lease the property. And we kind of went back and said, well, we can't lease the property until we do the improvement plan. They said, well, sorry. So we're stuck in a chicken and egg scenario here. And so we basically went and reassessed, like, well, we're not going to win a fight against Wells Fargo. They're bigger. And what can we do to basically enhance the deal, enhance the balance sheet of the deal for the lender and for us? So we looked at basically where's the highest value buildings that we have on the property, and let's start selling those off one at a time. So our basis on these deals is roughly $80 a square foot.
Yeah, we bought it at 81. Our basis right now is 86. And we've got 2 of these out the door at 130 a square foot.
Yeah. So our thought is, like, if we just keep going one by one, cherry picking the stabilized buildings, selling them to the market at 130 a square foot, we're winning.
Yeah.
So we very much feel like we're winning. All the proceeds though, instead of paying them out to investors and distributing them, they're all being used to pay down the loan, to right size the loan with Wells Fargo. So we're in
Well,
better standing with them,
yeah, in their opinion.
in their opinion.
Right. So, I mean, we had a roughly $3 million CapEx loan going into this that they decided that we were no longer going to do anymore. So that part of the draw process was removed. And then typically when we do sell a deal, the original discussion was that we would pay it down pro rata. So if we have a deal, we're into it for 86 a square foot, and we have $50 a square foot in debt, and we sell something for 130 a square foot, you know, you're going to pay down 50 in debt and you keep the rest in cash. We could have used that for CapEx, but they're taking the full $130 a square foot and basically sweeping that cash, applying it to the loan balance. And they're also making us pay the bank transaction costs outside of that closing. So we have to bring cash to the table, even though we're making great money on a sale. So it's a tough, we did not foresee some of these situations here with the lender. It was not fully what we agreed to with them, but you know, that's up for debate with them. And we do not plan to go the legal suing each other route to solve that with Wells Fargo. We don't think that's a good strategy. We probably just won't even win anyways. So we are just paying down deals. Once we stabilize each individual one, we're going to exit that deal and pay down the note as much as we can. That'll either put us in a position where we can refinance that loan to someone else, or we just aggressively just keep paying it off.
Until there's nothing left. Yeah. I mean, so we've done this with 2 buildings. The third one is under contract.
And the fourth one is in negotiations.
Yeah,
So
the fourth, yeah, and the fourth, yeah, exactly. And we started the deal right around 65% leverage. We're down barely at 50% now. By the time these other 2 sell off, we'll probably be in the 30% range of leverage of what we paid for it, not what today's it's worth.
Yeah.
So
that's what we're doing there. We have that structured as the initial sales are return of capital type scenarios, and then we'll be left at the back with the capital gain situation. And that's where we plan to say, hey, we either could refinance the remainder of this or sell the remainder of it as a bulk and figure out how we are going to handle the 1031 component of that and manage the capital gains. But we very much plan to continue selling one by one and realizing the value that we've created there. I would say, yeah. I mean, we are always trying to improve and get as much as we can in the due diligence process. But one of the tricky parts we run into is the type of people we buy from, and it goes on any deal, retail, commercial, apartments. It's like typically we're not buying from a well-seasoned operator. We're buying from a more individual mom and pop, and that's kind of where we see our value creation, right? So that's a different purchasing experience. We can't necessarily go in and say, hey, we're going to bring the county in and all these inspectors in to inspect your deal and see if we can find anything wrong with it. That is normally a challenge when we're working through any of these situations. So some of the things we've run into is we'll buy a deal, we'll then call the county in to say, hey, we're looking to do these tenant improvements. And like, well, you know, the floor plan or the designs you have don't match our last update from 15 years ago. And they work with us to say, what do we have to do to update this and get it to be current? However, that just takes more time than no time, right? And that's really where we see the biggest hurdles. Some of the ones that have been the longest are like Dawson, for example. We signed a great lease there. We signed a 40,000 square foot lease, but we had to put a sprinkler system in, and that required us to ultimately have to redo the main water supply line all the way back to the street, which was 1,000 yards away, you know? And then to do that, the city then and county needs an easement to be able to access that. So these are things that just have review timeframes and in lengthy discussions that have to happen. They need their time to do them.
I mean, one thing we do during due diligence on the front end, that's on top of survey. So we'll get an Alta survey that basically tells you all the boundaries and all that stuff. That's more of a physical property, but the zoning report that we always get done is super helpful, because not only does it tell you what the zoning is, what it can be used for, and kind of pull all the data and put it in one place for you, but it also gets letters from all the county and city officials saying that this building is currently up to code and it's used for its intended use, Or if there are issues, this will come up in the zoning report on the front end.
Yeah.
That we'll have to address. So if anyone's out there buying commercial properties, we highly recommend getting a zoning report. Normally runs about $300 to $500. Very valuable piece of information. Yeah.
Duke, I mean, the biggest part we have there is an extension and expansion with our Allmac tenant that is there. We've been working on this lease with them since June of 23. So coming up on 8-9 months that we're doing it. They paid us a security deposit for it. So they started that process, but it's going to probably take us another couple months before they're fully signed and us start on the construction there that they want. Their build out costs. This was not a, hey, we'll give you $20 or $5 in TI. I think they're going to be spending hundreds of dollars per square foot overall. And a lot of that is their cost, which they're happy to do. And we're working on the build out plan together, but it's going to be a while before that one is finally in and fully occupied with that tenant. They're the best tenant to take the space. They already have space there. They wanted more of it. As soon as that happens, that's when we're going to have to sit down and look at, do we refinance this or should we sell the deal? What does it look like on the capital stack at that point?
And for the build out, this is money that we have reserved and we have planned with the bank. Our lender has agreed to release that to us. We talked to them last week. They're 100% on board with giving us the money. So we're in a really good place with this lease.
Yeah, we have
and build out. Just
$1.5
time.
million that we have there to go do this build out over. It's 10,000 square feet. We don't plan on using all of that,
Right.
but we'll have release. Well, hopefully we can do it as efficiently as possible to get this tenant in there with a long-term lease.
Yep.
So, at that point, as soon as they sign that lease, that's when we'll have the highest weighted average lease term at the asset and make the decision then on what's the best course of action there to hold, refinance, sell. We'll run our model at that point. So, yeah. So this one.
This is the we called it the rate bureau.
Yep. Rate bureau. We're super excited about this deal. When we first had this, and we expected them to sign an extension. This was a building that was built originally for the North Carolina Rate Bureau. So they had, they've been the only tenant that's there. It's 2 floors of about 23,000 square feet. And even going through the renewal process with them, we offered them over $1 million in incentives, which was rent, TI to convert it to whatever they wanted it to look like. And we had a lot of upfront reserves to prepare for this. We knew we were going to have to be negotiating it, but ultimately they decided that they're just going to move. And there wasn't, we couldn't convince them otherwise. Money was not going to do that for them. And ultimately, we believe it just came down to the relationship that tenant has with their leasing broker. And they decided to move to another location. So their lease is over in August of 2024. So that obviously not ideal, not a situation we wanted to have. We thought we would be able to keep them. That was the business plan there. Without being able to keep them, we're now going to have to release the space. We can't do anything with it really until the third quarter. We can start showing it. We can start, the leasing discussions. So we have a good amount of time and we have a good amount of TI dollars allocated to it. But there'll be continual more updates on that one as we get, through the coming months here and into August. A lot of times we buy the shorter term leases, and the value opportunity is that we can extend these things and get a new 10-year lease, and it just didn't happen here. And I think we missed just on our relationship with the leasing broker associated with it.
Yeah, we've done turnover on whole buildings before. If anyone was involved in our Black Sheep, literally the business was called Black Sheep, but we had a tenant called Black Sheep in a restaurant bar in town, and they went bust 9 months after buying it. Maybe 12 months.
It started COVID.
Yeah, pretty quick.
And then it took us almost a year to get them out of there.
Yeah, it took us about a year to get them out of there, but it turned over. We leased it well, and then we operated it with the new tenant in there, and then we sold it and did very well with it.
We bought it for $2, and then we sold it for 2.6 from what I remember. Yeah.
Mm-hmm.
Yeah. So there's opportunities it's not just dead in the water and everything's gone. It's like we have reserves in place for this. We do have good relationships with our leasing and sale brokers. I mean, that's a huge part of our business and what we're doing. So with as much lead time we have and time, I'm pretty confident we will find a solution here. Just don't exactly know what it is yet.
Right. And we have 5 properties in Raleigh-Durham area. They're all, I believe they're all now 100% leased because Almax signed theirs. Summit's 100% leased and everything else is single tenant.
Yeah.
So we have we can basically use our other properties to feed tenants into this building as well.
Yeah. So basically, what the heck's going to go on now? So we look at like how we're pro forma or explaining like what we expect to happen at a deal, and this is an area that we need to improve on a little bit here to help try and tell the story better. We're reserving on a monthly basis. We put that in pro formas annually for leasing commissions and TI improvements. Here at Henderson Mill, we had 2 really big leases that renewed this fourth quarter, and we basically had to pay for those. We had our OSHA renewal. They went through 2033. So like this is a big, a 10-year lease. We pay a 2% leasing commission on the total value of future leases, whether they stay, whether they're not. Sometimes we're picky on that part, but so we got $23,000, 23,000 square feet through 2033. So very positive there. And we had the VA hospital renewal. That's through June of 2033. So we have 2 leases that we just got 10-year extensions on, which were good. But that put us over $200,000 in leasing commissions. There was not a lot of TI, but a lot of leasing commissions associated in the fourth quarter to pay for this stuff.
It brings us to 97% occupied, which is fantastic.
Yeah, our average,
that's above pro forma.
Yeah, and our average tenant lease is 40 months.
Mm-hmm.
So we're in good shape on this. But yeah, those leasing commissions fall in our controllable operating expenses because we do see those as a controllable item, and they were significantly higher than planned. We are going to try and do better as we budget this stuff and match what we expect our leasing commissions to be on an annual basis versus just saying like, hey, we reserve this amount and as they come up, we'll pay for it. Couple of things here. Our management fees are fairly consistent. They're a little bit different on the retail side.
Correct.
Right.
We don't do management fees.
Yeah, there's just a 1%
1%
asset management fee on the retail side, and on the commercial and residential side, it is a 4% management fee, and then we have a pass through of if time is spent on a property by our operating team, they bill that time to whatever the property was that they're working on. So there's that. There is some fluctuation on whether they're what project or what lease or what happened on that asset to change it. And the other part is that we kind of internally, we call these our like spread costs, which we're always battling, which is costs that we try and purchase collectively across our properties and then allocate to them evenly. So one example of that would be like cell phones. Instead of having, 100 different cell phone plans, we have one. And then we split that across the properties based on how many cell phone lines there are. But even that stuff, our cell phone bill got up to like $5,500 a month. All of these are things that we're constantly trying to battle and get down. So our management contract is basically saying, we'll go procure that stuff for the properties and try and do the best job we can. That was one where costs were pretty high. We're trying to go to as many virtual phone lines as we can now to get that cost down. We have that trending down to like $1,600 a month now, but we were with AT&T for a long time and just kind of got out of control on the cost standpoint. We're doing it with it's almost like a game of whack-a-mole. We're doing this constantly every quarter. It creates a lot of churn and turn in the business from work. But like DocuSign, we sign all of our leases with DocuSign, and that got up to about $14,000-$15,000 a year just to sign our document leases. So I had to get rid of that program, right? And we switched to a company called Nitro PDF, which is a whole lot cheaper.
Yes.
But there's always costs like that we're trying to save. Right now, our operating account, if we look just at our distributions, we take a lot of distributions. The management company is doing this and funnel it to one bank account and sending it out. Obviously, we have to pay a lot of ACH and transaction fees for that. That totals about $2,500 a month that comes out for those. And we're working on another solution to be more efficient with our ACH transactions so we can avoid a lot of those costs. But it's really every quarter we get some kind of renewal. We get some kind of, oh, here's going to be your cost increase for this. And we're like, oh, we don't want to pay for this. And I find us constantly battling to reduce those costs as much as we can.
Yeah.
So it does fluctuate every quarter. But yeah, we're trying as much as we can to fight any of those renewals that are just unnecessary price increases.
Yeah. So one of the questions that came up is really what's inside the 4% versus what's outside the 4%.
Yeah. So, I mean, the 4% management fee is the management of doing it. The outside of that is the salaries for on-site people that are working on a property, and then DocuSign or utilities or services that the properties are using. That's not in the 4%. That's outside of it. And you're going to see that as administrative costs that are on a property. And those are the things that anything that we can buy in bulk or anything that we can get a group discount on, we're going to fight as much as we can to save that. Where we can't is things like utilities, where we've got trash contracts. We inherit a trash contract and it is what it is. It's signed for a set amount of time. We use a third-party vendor on some of those too that we'll pay for to help us renegotiate those if they have a kind of a backdoor connection to that vendor. What's another one? Right, a lot of the costs we're looking at right now are cleaning costs too, where we'll have a contract that says one thing and we're getting charged something vastly different. One of our, we just did an audit of some of those. One of our cleaning contracts was $865 a month at our Park Lane asset, and we were getting charged like $2,200 a month. And that's just what was there. We inherited that contract. We're working on redoing all of those to realize that savings. So there's constant like expense creep that we're trying to see like, hey, if we sign 4 contracts, well, can we get a discount on these together? But other point of that too is we'll post all into the investor portal. We can post all of our managed agreement contracts. They're all fairly the same with all their wording and how they're structured. And the 4% is just 4% of revenue that were collected. But we'll put those in the investor portal too, so that everyone can see what they are. And any options for saving money on stuff, we're all ears.
Yeah,
we'd love to hear.
Yeah, any enterprise software that basically replaces a behemoth at a lower cost.
Yeah, all the legacy
Yeah.
software as service that we came into thinking these are going to be great and very helpful. Like DocuSign is a good example, just got prohibitively expensive.
Yeah.
I don't know what it was when we first started, but it seemed like it was like $10 a month.
Right.
And even Entrada to Yardi was a big savings.
Oh
there.
yeah, that was
Yeah. That was a big one.
that was almost
Thousands of
18 months ago at this point.
Yeah.
But yeah, no, we cut some of our property costs from like $1,000 a month to $100 a month.
Yeah, per
property.
property. Yeah. So thousands and thousands of
Yeah,
dollars
so-
every year.
Significant, but it requires a whole heck of a lot of coordination to go pull off some of these transfers.
At high level, it was IHOP Spring, Applebee's Sumter, Applebee's Seneca, Palmetto, a
Yep.
couple random Midtown ones, and Kingstown.
Very good. You get
Good
A
memory.
plus for remembering those.
A for
Yeah, so
God.
those are the 6 or 7 that we plan to exit in 2024. Right?
And again, when we look to exit deals, we are first contacting usually 2 brokers, asking their opinion of value. Then we let them formalize a report showing us the value, which shows kind of the target high and low range of what they expect to get. And that's when we basically start communicating out with investors. Hey, this is what we're targeting to do. Then we let them take it out to market. Normally it's out to market for 60 or so days. Then we do a call for offers that usually takes 2 to 4 weeks to get the offers back in. So the whole process from say day 1, we're going to sell the deal, to the day that we accept an offer is usually pretty close to 5 or 6 months. And then it takes the new buyer about 90 days to close the deal. So the whole process is just under 9 months, give or take. And that's assuming things go well. If a buyer blows up in the middle of a transaction and we have to basically go back to another guy, that just extends the process. So
Yeah.
nothing's happening urgently.
That was North Graham last
Yeah.
year. I mean, we spent 12 months trying to
Oh.
sell the North Cram deal because we had owner occupants
Paying
who were going to take that space.
They're paying,
They were
up
going to
big
pay more.
time. Yeah, they're paying 20-30%, over what we owned it for. It's like, man, this is a great deal for us. And yeah,
But yeah,
they
we
just blew it
spent
up.
months just
Yeah, we lost a year.
working with them per transaction time.
Mhm. Yep.
Yeah. So,
Yeah. So if the preferred return accrues during the whole deal. Yeah. Yeah. So the preferred return accrues over the lifetime of the deal. So every day, every month that goes by, we are accruing a preferred return. That could be 6, 7, 8. Some of our deals had 10%. We will pay out distributions as the property earns money, and those first go against the accrued preferred return. And then once that accrued preferred return is caught up, that's when we start getting into profit distributions. So deals that basically are under construction, have an extended timeline. If things go, if things take longer than expected, that accrual just builds up more and more. And some deals, they don't catch up until eventually we sell them. But other deals we catch up because they perform very well, and then we start and then we start paying out normal preferred returns going forward.
yeah. Midtown, we will not be making distributions now that, we did our first round of CapEx there. We spent just over $500,000, and that was, we were not able to get our bank draw for that spend. So we were out that cash. And then even this recent sale, we had to pay all of our closing costs outside of the deal, and they kept all of our money. So our cash flow there is negative because we are paying everything to the bank.
Yeah, I mean, our balance sheet got $2 million plus healthier, but our cash got what, $75,000
Worse.
Yeah,
Yep.
worse. Yeah.
So that trend will continue there. Wells Fargo is not going to reverse course on us. They're not going to change that decision. So any free cash flow we make, the bank will basically be from sales. Any free cash we generate on a sale, the bank will sweep all that cash. So that'll really limit our ability to make any distributions until we complete our refinance there or sell the deal as a whole.
Yep.
So our CAM process, a lot of when we inherited buildings, they did not have CAM in place or they wasn't being charged. And TVTC was one of those. Now, granted, we bought this thing in 2019. So we've owned it for a while. We went back one by one to our tenants, and we explained in the third quarter where we posted 2 years of CAM. At TVTC, it was roughly $280,000 that we posted. And we said, look, the monthly CAM rate to get caught up to where we're currently at now is going to go to about $24,000, up from 10 collectively, split across various tenants. And there's $280,000 in back owed CAM payments. So we charged all that. That all shows up on the income statement. When we got to the negotiation and working with those tenants, they did not pay the full back owed CAM. And you could say, yes, what's owed, what's not owed. We're trying to be reasonable with our tenants, keep them happy and keep them in place. So they paid about $160,000 of that. And then they agreed, look, they're going to be paying $23,600 a month going forwards on those spaces there. So we look at the fourth quarter, and there was some CAM that was backed out. So when we look at our CAM reconciliation number, it was a lot higher in the third quarter. It came down in the fourth quarter. And now we have a steady amount going forwards. We'll renew it again at the end of 2024 to see, what is owed and not owed for the year. But ultimately, we got to make our CAM as affordable as possible. Our residents are counting on us to keep those costs under control. And really, they have a fixed amount that they can pay. No business wants to go pay more for their space. So we got to keep it as affordable as possible and do the best job we can for our tenants to keep it low. So hopefully we look at our CAM for 2024. Hopefully we can get it go down. That'd be awesome. That means we just save that much more on expenses across the board operating the property. So that is it. Those are all the questions that we had that came through. We'll keep it open and see if there's any other questions that you have on deals. Happy to go through them all. And any of the deals we do have known events coming up for, we're going to be sending out just deal specific updates. They'll just go to you and the specific deals that you're in. We have a couple of those coming up. With all of the sales stuff we mentioned, we're already in the works on doing that stuff. So we're making progress there, and we'll have more information as we have those out too. So,
Sounds great.
yeah. We'll leave it open for a couple minutes if anyone has any questions. Forum, we have 60,000 square feet that's vacant.
So, well, first of all, we had 2 buildings. One of the buildings had one tenant in there, and we're taking that tenant and moving them over to the other building, and that building will be just about full. 80
Yes.
plus %.
It'll still have 16,000 square feet that's vacant there.
Okay.
Right.
And then the original building that we were talking about is now fully vacant. And that's where we're talking about the car storage.
Yeah. And then, but we going through these conversations, we met a guy who has a bunch of cars that he would like to store. This isn't his version of it.
Yep.
And we're working with seeing how quickly we can get an approval with the city to say they would allow this use to have him in the space. So we'll know more on that by the end of February. That's kind of his drop dead date to know whether you can do this or not. Or we have to be able to say, yes, you can do this for him to accept it.
Right.
But we've got to get, we have to meet with the city and see if they will give us a CO for that use there. So we're optimistic that we'll have an answer by February.
Right. And if all goes to plan, that whole building would basically be full.
Yeah, if we can make that happen. So we're working on that. Okay. Thanks everyone. Appreciate the time. If you have any questions, let us know. Happy to answer anything and talk through it.
Thanks.
For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.